Well, hello again, Merle Dimbath, and what a week it has been. Stock market hit all-time highs, the best week in since 2020, as I recall the data. And on top of that, were strong reports by various corporations with respect to their first quarter earnings. So all in all, a very happy week for investors. And a good indication for the economy that a lot of things are happening. A lot of reports about artificial intelligence investments into the billions of dollars. And of course, in addition to the strong company reports, why the Federal Reserve met, and as expected, there was no consequence of note there. The interest rates were remained unchanged, and that was expected. We did see the final presentation by Jerome Powell, who is leaving his position. His position has expired as Federal Reserve Chairman. And he announced that he's not going to be leaving the board. He's entitled to stay on, but customarily, when a Federal Reserve Chairman leaves the position of chairmanship, they resign from the board too. But Powell is so impressed with himself, it's clearly the height of conceit to think that he is so important that he needs to stay on to guide the Federal Reserve and have the benefit of his wisdom. It has been a very unfortunate experience. I'm sure President Trump has regretted many times ever appointing him to that position back in President Trump's first term. Powell is, I guess, a nice guy. He was trained as an attorney, which is a fine and honorable profession, but as he has very well demonstrated, it certainly doesn't prepare you to be chairman of the Federal Reserve System. But in any event, Kevin Warsh apparently is going to be his successor. And well, some other bright spots: the employment picture. We have reported previously about layoffs in the various industries that are incorporating AI into their operations. Of course, this has received a lot of attention in the press, but because the economy has been strong and there's been a lot of investing going on by corporations into their operations, AI and otherwise, the economy is strong and jobs are being created. So this helps to offset whatever losses may be incurred, at least at the present time, through the AI layoffs. Some other data. In the month of March, payrolls increased by 178,000, and that was a very good gain. Unemployment rate remains at 4.3%, which has been fairly constant. The report for April will come up later in May, and so we'll find out what the unemployment situation was for the month of April. The most recent data is for March. Wage data has also been revealed for the month of March, and again, we'll get April data later. But for the month of March, median weekly earnings for wage and salary workers was $1,235, which is just right around $65,000 a year. That has been increasing over a period of time, but when you consider the cost of a new car today and the cost of a new house, you can see why there is still a problem between median wages that are being earned and the median price on cars and the median price on houses. There's still a unfortunate ratio there compared to what it's been historically. I mentioned the growth in the economy. Specifically, we've seen an improvement in the growth rate of the gross domestic product. For example, in the fourth quarter of last year, the growth rate was 0.5%, 0.5. But in the first quarter of this year, 2.0. So we've definitely seen an increase here in our economic growth. But there are some negative things, and of course, one of them has to do with the war in Iran. We've had a ceasefire, I guess I should call it. That's what it's referred to, but there's still no final decision on that yet. Fighting could erupt, I guess, again at any time. And that in turn, of course, has caused a increase in the price of petroleum because of shortages in the quantity of petroleum available as a result of the Iran conflict. And that in turn has seen inflation domestically. And that's going to continue with us for the foreseeable future because we really don't know when the Iran problem will get resolved. The most recent figures for inflation that we have are for March, and at that time the year-over-year rate was 3.3%. But what was disturbing was the month over month. The March increase in inflation over February was 0.9%, 0.9%. On an annual basis, that's over 10%. Now, again, we're going to be getting a report in a week or so here on the CPI for April, and I'm afraid that we're going to find an elevated level of inflation as a result of the spike in petroleum prices. Not surprising with the expansion of government spending and the expansion of domestic spending and the inflation that we are experiencing. Not surprising, we've seen an increase in the money supply, and the Fed is responsible for controlling the money supply, and under Chairman Powell, they have not done a very good job of that. I've got a couple of clips here to show you that we've seen a very sharp increase in the money supply. I'm talking about the M1 money supply, which is basically currency in circulation and a broad range of checking accounts at a commercial bank, at a savings and loan, at a credit union, and other kinds of checkable deposits. And the minority part of the money supply is actually currency in circulation. The bulk of it is various types of demand deposits in different institutions, as I indicated, banks, savings and loans, credit unions, and other. And the federal debt has been increasing. And the federal debt is now $31.3 trillion, if you can imagine such an amount. And we're adding about $1 trillion so that this year. The interest rate on the debt is up to about $1 trillion. It defies comprehension how we are getting ourselves in such a mess. And this does not end well. I'm not sure exactly how it's going to end, but I've got some ideas, but it's not going to end well. Our debt is growing faster than our economy. We haven't seen debt at these levels since World War II. Not surprising, with a growth in the federal debt and a growth in the money supply and an expanding economy, this is not the stuff that generates low interest rates. This generates high interest rates, and interest rates have been going up. I have pointed out previously that over the last 12 to 15 months, the Federal Reserve Open Market Committee has on several occasions actually lowered short-term interest rates, which is what happens when they adjust the federal funds rate. That's a short-term rate. And as I've also indicated previously, what this has produced is lower interest rates at the short end. In other words, for 1 month or 6 month or 1 year Treasury bills, those interest rates are indeed lower. But at the opposite end, at the long end, 20 years and 30-year bonds are higher today. The yields on 20 and 30-year bonds are higher today than they were a year ago. So the Fed in the future may again try to lower interest rates, and they may very well under the new Chairman Warsh. But are we just going to see a reduction in the short-term rates while the long-term rates go up? The next meeting of the Fed is going to be June 16. It will be June 16 and 17. I don't know that he's going to succeed in lowering rates on the very first meeting. I suspect that from a political point of view, he would like to do it prior to the fall elections, which are coming up in November. And there are 4 meetings of the FOMC between now and then. There is the June meeting, as I indicated. There's also one in July of 28-29, the very end of July. Mid-September 15 and 16, and the very last one prior to the midterm. As I've indicated before, mortgage rates are very much geared toward the yield on the 10-year bond. And the 10-year bond is now running around 4.5%, 4.4%, higher than it was in September, in December. In December, it was just a little over 4%, and it's now 4.4%. So we have seen over the last several months long-term interest rates going up. Short-term interest rates may have fallen, but the long-term rates have been going up. Hard for the Federal Reserve to justify lowering rates when so far the economy is doing fine. Unemployment seems to be holding in line. And particularly when we've got a war in Iran or a potential resumption of the war in Iran, I would think that we would have to have some type of resolution to the situation there. Now it looks like a boom and inflation are in the future, at least in the near term. That's my report for today. Thanks for tuning in. Please subscribe, and I'll see you next time.